Welcome to Trading Pro. Through our previous courses, you should have mastered the basic candlestick patterns and their combinations, which gives you a simple ability to read market strengths and weaknesses. At the same time, you can also recognize common structural patterns in the market and make corresponding decisions. However, just learning these skills does not guarantee consistent profitability in trading. At this stage, it's like a novice just learning how to use the MACD indicator or Fibonacci retracements and believing they can already control the market. However, in reality, they can't even reach the threshold of consistent profitability. The movements in price are unpredictable, and no pattern can provide us with a 100 success rate. A structure that looks extremely favorable now may no longer be in our favor a few candles later. Understanding and accepting the uncertainty of market movements and the changes between structural patterns and then making corresponding decisions is what we often call integration. In today's video, we will mainly explain some basic laws of price movement to help you link all the knowledge you have learned before, making chart reading easier and simpler. The basic principles of price movement are: 1. Uncertainty or multiplicity. We've mentioned this term multiple times in previous teaching videos, but have not delved into the logic behind it. The uncertainty of price movement is the basic principle and underlying logic of our technical analysis. If you can't understand and accept this, it's hard to get on the path to consistent profitability. Unfortunately, the reality is that most traders can't understand uncertainty. Many people are still chasing the holy grail of trading, chasing a trading system with a 100% win rate, thinking that if conditions 1, 2, and 3 are met, they can make money. To understand the uncertainty of price movement, you need to first understand why prices rise and fall. It's simple. If the money used to buy is greater than the money used to sell, prices rise. If the money used to sell is greater than the money used to buy, prices fall. So, who determines the buying and selling money in the market? That's also simple. All participants in the market make decisions to buy or sell based on their own analysis, which ultimately affects the market price. Now, let's analyze the first question. Who are the participants in the market? This question cannot be easily answered. The composition of market participants varies. Some markets are dominated by retail investors and some by institutions. Let's take the traditional large-scale investment market as an example, where both bulls and bears fully play. The participants include large investment institutions, banks, hedge funds, and small speculative institutions. Although they are all institutional participants, they participate in the market in different ways. Large investment institutions are so large that their entries and exits directly affect price trends. So they tend to operate conservatively, holding positions for the long term in pursuit of annual returns. Small speculative institutions don't have to worry about these problems. Their trading methods will be more aggressive to maximize profits. Some institutions even trade a particular variety, not to make money, but to hedge against other risk assets. In addition to institutions, there are also retail participants like us in the market. However, not all retail traders are the same. Some have funds equivalent to small institutions. Some have a small amount of capital. Some retail traders have professional technical analysis or fundamental analysis skills, and some know nothing and trade purely on feelings. From contemplating this first question, we realize that the composition of market participants is complex, not just a simple opposition between institutions and retail traders. Different types of institutions have different purposes and will have different views on the market. Among retail traders, not all are small investors. There are also large professional investors. Now that we know the composition of market participants is complex, let's consider the second question. How do these different participants analyze the market and make decisions? Answering this question is also very complex. Let's talk about institutions first. To simplify, let's not consider the size of the institution, only their analysis tools. The analytical tools used by institutions are not uniform. Some use fundamental analysis, some use technical analysis, and some use mathematical quantitative models, not caring about either fundamentals or technicals. The field of technical analysis is even broader, with moving averages, price actions, various indicators, and even more diverse quantitative models. We won't talk much about retail participants. Most retail traders do not have analytical tools. They basically follow the trend and buy whatever sector is hot or buy a stock when its price drops from 100 to 10, thinking they found a bargain. As for professional retail participants, the analysis tools they use are quite similar to those used by institutions. Through analysis of the second question, we find that the analytical tools used by market participants are diverse. At this point, I believe many of you already have some understanding of the multiplicity of price movement. The result of the competition between funds causes price fluctuations, and the buying and selling of funds come from the analysis and decisions of each market participant. But there are many different types of participants in the market, and they use a wide variety of analytical tools to make decisions. At the same time, we cannot accurately grasp the emotions of each participant. All these factors combined make it impossible for us to accurately analyze the ups and downs of price movement. There is no person or institution in this world that can accurately predict price fluctuations. As long as you participate in high market cap, high liquidity assets, there will definitely be multiple institutions playing the game, which means there is price uncertainty. Let's feel it through an example. This is the 4-hour chart of crude oil. When you get this chart, how would you analyze the current market state? There are 3 characteristic actions in the current market: an upward false breakout, a breakdown of the trend line, and a test of the support level. Different types of participants will have different analyses and decisions based on the current chart state. I'll give a few simple examples. Suppose you are a short-term price action trader. You see a rapid drop to the support level and think that the bearish momentum may have been exhausted and a trading range may be formed. If the market gives a bullish entry signal in the form of a candlestick, you would actively participate. But the choice of an entry signal candlestick varies from trader to trader. Single candlestick reversal, double candlestick reversal, first breakout, second breakout. The same bullish logic will have different traders choosing different entry methods. Suppose you are a reversal pattern trader. You see an upward false breakout and a significant break through the trend line and think this is a potential reversal pattern. When the price retests the previous high, you would short. Some people might gradually build positions during the retest process. Some might wait for the trend line to be retested before participating. Some may wait for a reversal signal candlestick near the previous high before entering the market. Suppose you are a trend trader. Here we can demonstrate using the Vegas moving average group. You can see this is a strong trend alignment of the moving average group, and you would think this trend is still healthy. Currently, it's just going through complex adjustments, and the trend will continue afterwards. Now we realize that for the same chart and market condition, everyone will have different views and decisions. So, who is actually correct? We have discussed a common misconception in trading before called outcome bias, which is to look only at the trading outcome without considering the logic and reasoning process of the trade. This is clearly wrong. As long as your analytical logic is correct and your entry and exit positions are reasonable, regardless of the final profit or loss, your trade is okay. Since market movement has uncertainty and cannot be accurately predicted, what is our purpose of learning technical analysis for trading? Being bullish or bearish, isn't this the same as saying nothing? It seems like flipping a coin for decision-making would be easier. Actually, we learn technical analysis to find fleeting advantages in an uncertain market. This advantage refers to the combination of the win rate and the profit-loss ratio. Even if a single trade is a loss, as long as every trade you make has a mathematical advantage, you will definitely be profitable in the long run. Uncertainty is the underlying principle of market price movements. We need to understand and accept any market trend using technical analysis to find advantages in uncertainty. After understanding the uncertainty of price movements, we know that no matter how perfect the entry pattern is, it can fail because there are always people in the market who hold opinions opposite to yours. In my trading, there's a quote from Al Brooks' book that always reminds me and saves me from many detours. I now share it with you all. No matter how confident you are in your judgment, there are always equally smart people who are just as confident in the opposite judgment. When you encounter a great trading opportunity and are very certain about your judgment, with the impulse to go all in, I hope you can remember this sentence. Any pattern can fail. After a pattern fails, a new pattern will immediately form. For example, if a simple pullback in a one-segment pattern fails due to insufficient trend momentum, it will become a two-segment pullback. If a two-segment pullback fails again, it will become a three-segment wedge pullback. If a potential reversal pattern fails, it will become a trading range. If the trend direction breaks after the pullback pattern fails and a breakout against the trend occurs, it becomes a reversal pattern. All these cases are quite simple, and we have talked about them in previous lessons. We can't accurately predict the changes in patterns. The core of trading lies in the strategy. If you, after some time of practice, understand and accept the uncertainty of price movement and can skillfully recognize the changes between patterns, you have surpassed most traders in the market. However, there is still one last step to consistently profit from trading: your strategy in a constantly changing market, which is order management. Only a small number of trades go as expected right after our entry. Most trades are very volatile after entry. Your ability to respond determines your trading level. But order management is a big topic and can't be explained in a few words. I will open a new course later for a deeper explanation. For now, let me provide some thinking directions. You can start from these perspectives to consider your own order management strategy. First, the setting of stop loss and take profit after entry depends on your trading system. Second, if the stop loss or take profit is directly hit after entry, there is no need for order management. Third, if the market is flat after entry. Fourth, after entry, the price stops and reverses before reaching the take profit target. Fifth, the stop loss is triggered after entry, but a great second entry opportunity is immediately given. Why is order management a complex topic? Because different types of traders, aggressive and conservative, have different order management strategies in different trading systems. This topic has no standard answer. Everyone has to find their own way. You can start thinking about what you should do if you encounter the above problems in trading. When you understand and accept the uncertainty of price movement, can skillfully recognize changes between patterns, and also have your own strategy, then congratulations, you have already set foot in the doorway to consistent trading profit. Finally, one more point. Some friends ask why it seems so easy for you to read charts, always able to find key patterns and signal lines. Why does trading seem so simple for you? While when they trade, reading charts is slow and they can't find key information, and thus lack confidence in trading. Actually, this is due to the difference in trading experience. Recently, I had a trader friend visit and we discussed a lot about our trading experiences. His initial trading teacher was also Jesse Livermore and Al Brooks, so our trading systems are very similar. Moving averages and price action, the entry signals differ from my system, but the entry logic is the same. However, even using similar systems, he is able to achieve a surprising win rate and profit-loss ratio. If I hadn't seen the trading data with my own eyes, I wouldn't believe it. He uses this system to trade 500,000 US dollars, making an average profit of 150,000 to 200,000 US dollars per month. Moreover, this was a level he reached 2 years ago and stopped compounding since. If he had continued to compound, I can't imagine what his account size would be now. Why is it that with virtually the same system, his trading level is much higher than mine? It's also due to the difference in experience. The longer you trade, the more trades you've made, the more chart reading experience you have, the better you can identify what signals have advantages in the same system opportunities, and what signals are not worth taking. You will subjectively make choices and trading will become more natural. In his own words, reading candlestick charts for trading is as natural as drinking water. Entry, exit, order management doesn't require much thought. Therefore, I believe that a novice going from trading beginner to being able to consistently profit, to becoming a trading expert and slowly accumulating wealth, to eventually becoming a master and achieving financial freedom, each step in between is an accumulation of experience. Alright, that's for today's video. And if you like this content, please like, comment, and subscribe so you won't miss out. And I'll see you in the next video.